have a final question for you. You put out an article in IOG's Economic Intelligence Report last week, arguing that tariffs might not be the end of Trump's disruption. Rather, they may be only the first step in a wider plan to address the trade deficit by devaluing the dollar. Could you elaborate on that part?
Yeah, this is what people have been calling the Mar-A-Lago Accord. So that article I wrote analyzed the idea of the Mar-A-Lago Accord, which was proposed by Trump's chair of the Council of Economic Advisors, Stephen Moran, right after Trump's election, but before he entered the government. So I encourage people to read my article and also to read his article called A User's Guide to Restructuring the Global Trading System. But in summary, Moran suggests that tariffs could be used to incentivize or coerce U.S. allies and partners into an economic and security bloc. In this bloc, U.S. defense commitments and U.S. market access would be compensation for investments in the U.S., low tariffs on U.S. exports, and economic rights to strategic materials like critical minerals. Now, the U.S., after they identify the friends and foes, they would attempt to facilitate a coordinated devaluation of the dollar with these partners. This is why it's called the Mar-A-Lago Accord. It's theoretically it would be like a new Plaza Accord from 1985. So the reason for this is Moran and other Trump advisors, including Bessent, they believe trade policy is not enough to address persistent U.S. deficits. They think that the actual source of this imbalance is dollar overvaluation. Trump has said that the new tariffs will put the U.S. in the driver's seat, directing events as trade partners come to negotiate. And he may even want to use these negotiations to not just achieve these economic goals, but also geopolitical goals, geoeconomic goals for the America First foreign policy. Now, if Moran's plan is actually the strategy, we don't know if it's actually the strategy, but if it is, any concessions in these trade negotiations, the U.S. trading partners will be asked to combine trade, defense, or industrial policy to lead to U.S. tariff reductions and reductions to the U.S. deficit. Now, it's too soon to say whether Trump has determined his next steps. I mean, he's still dealing with the fallout of his initial tariffs, but I think that Moran's plan is an interesting and provocative idea, and especially U.S. allies should familiarize themselves with it. Now, the worldwide tariffs may fit into his scheme. So if I'm right that everything above the 10% universal baseline rate is to build leverage for negotiations, then Trump is probably wagering, and I think he's correct, that the U.S. market is unique in its ability to absorb production, and doing it bilaterally this way does give him leverage. So I think that if he tries to create a bloc that will make these allies come together, that's one thing, but will he really be able to facilitate some kind of central bank coordination to devalue the dollar? I mean, that's totally speculative in future, but maybe that's the goal. So in that context, though, there's another point about the central role the dollar plays in this global trading system, one that's particularly relevant to the Trump administration. So as the reserve currency and used for oil transactions, the dollar's strength meant that the U.S. could import more than it exported, and then its trade partners would recycle these dollars back into U.S. debt, funding the government, but at the end of the day, contributing to soaring deficits. So right now, the deficit is one of the biggest problems for the U.S., as annual interest payments recently exceeded defense spending for the first time. I mean, think about Doge. What's Doge doing? They're trying to cut. Well, what are they trying to do on the other side? They're trying to raise revenues, boost growth, So the deficit's really at the center of how they look at the U.S. fiscal situation. So the problem is, now this is where it gets to the global economic system. According to most of Trump's advisors, including Bessent and Moran, this whole debt-driven system is because the dollar is the world's reserve currency, and the U.S. has to issue more and more debt to produce dollars to facilitate global growth. But as the global economy continues to grow and grow and grow, more dollars are needed, which keeps the dollar overvalued. It's now at its highest inflation-adjusted rate in 40 years. So that makes the U.S. less competitive when other trading nations, because its exports are relatively more expensive. And I think that when you viewed from that angle, dollar overvaluation may be even more important than tariffs and non-tariff barriers by U.S. trading partners to contribute to the persistent U.S. trade deficit. And Moran definitely thinks so. So he also thinks that trade deficits and ballooning government debt are kind of two sides of the same coin. This trend is fundamentally unsustainable, and they think that once the debt reaches a certain point, the whole global system will be in jeopardy, and the U.S. may not be able to afford its security commitments or to continue its social spending policy, or even maintain its status as the world's reserve currency. And if they really think that the system will break down because the debt is out of control, they may think it's better to disrupt and to restructure the system on U.S. terms at a time of the U.S.'s choosing than to wait for it to cause an economic or security crisis later on. So generally speaking, though, to relate trade policy to the value of the dollar, tariffs are associated with a stronger dollar, since in most cases, trade partners would likely aim to devalue their currencies to retain market share. We've seen this throughout history. But what's weird is that when Trump tariffed the entire world, and we're now in like uncharted territory where I'm not sure the assumption holds anymore. The effect of these tariffs could actually be dollar devaluation because tariffs are restricting the access to dollars that had previously been earned through exporting to the U.S. market across all U.S. trading partners at the same time. So given that, maybe the dollar will weaken. Hard to say. But it's interesting to think, well, it's weakened already a bit, but we'll see if it bounces back. So it's interesting to think about some of Trump's other policies from this perspective. So think about that proposed sovereign wealth fund. The idea is to monetize everything possible from federal lands to gold reserves and beyond in order to make investments overseas. So the idea is you take the sovereign wealth fund, deploy these assets to accumulate other currencies, then bring them home and intervene in foreign exchange markets to add downward pressure on the dollar. So the reason why I bring up this whole thing about the dollar is don't assume that the tariffs are the end goal. They say that they want to reduce the trade deficit, but like I said, they may be trying to negotiate to create something bigger or to even affect a long-term depreciation of the dollar. So tariffs could actually be a means to an end. And if you listen to what the statements that have been coming out from the administration, Trump and Bessent, they've said for over a month that they want the dollar to depreciate. They want 10-year bond yields to go down below 3%, and that this is so important that it was worth a market correction. And it's now happening. The dollar's down, stocks are down, and investors are shifting into bonds, causing 10-year yields to fall below 4%. So they're already approaching 3.5, 3%, which is where they said they wanted it. They said this administration is not concerned with the stock markets. They're concerned more with the bond yields. This is an important point. So why would that be the case? Why would any U.S. administration want the market to decline? Well, for one thing, it's probably overheated anyway, the stock market, especially those Mag 7 stocks. And I think that they want, if it's going to have a correction, they want to have a correction as close to Biden's term and as far from the 2026 midterm elections as possible. But more important than the politics, just over a third of U.S. debt. Now think about this, $9.2 trillion, around $9.2 trillion. That will need to be refinanced this year in 2025 because of the COVID era 3-year and 5-year bonds that were issued by the Biden administration that created all of this surging deficit. So for this reason alone, Bessent has said that it's crucial to get lower bond yields. Now consider the rates on 10-year treasuries. For every basis point decline, approximately $1 billion per year will be saved. A drop of a half a percentage point in these rates would equate to nearly $500 billion in savings between now and 2035 for the 10-year. So as unorthodox as it is, and as as dangerous as it is to take this gamble, unpredictable tariff policies are one way to push down bond yields despite inflation and a cautious Federal Reserve that doesn't want to cut rates due to inflation. Uncertainty about tariffs, and they seem to be imposed and removed without reason, calculated using deficits that is just makes no sense from the standpoint of real reciprocal tariffs. That rattles markets. It drives investors into bonds, so it cools down an overvalued stock market while cutting the cost of debt refinancing. So could this open up space for Trump's other policies like cheaper energy, deregulation, and tax cuts to stimulate massive growth by the end of the year into 2026? I mean, that's what Trump hopes. He seems he's committed. But I think that deals need to be made, and they need to be made soon, because there will be domestic political backlash if the stock market continues to just crash and it depletes the general public's assets and pensions. Then the Republicans risk losing big in the midterms in 2026, and Trump will be likely, held back with impeachment and all kinds of other congressional blocks to his policies. On the other hand, if this whole strategy works and if he can bring U.S. trade partners to the bargaining table, and this is really the beginning of a plan that can manage debt, boost manufacturing, and increase U.S. geopolitical leverage, the Republicans might defy the standard line that the president's party always loses the midterms. Who knows? I think he's trying to go for a Reagan-type policy, where Reagan's 1981-82 saw a huge recession, but then surging growth by 83, 84, 85. And then he wins 1984, 49 out of 50 states. Maybe that's in the back of Trump's mind. Now, if they fail, if it's wrong, this is going to lead to inflation, a trade war, U.S. global isolation. I mean, the negatives are off the charts. So, and it could all go wrong. Most economists think that these massive tariffs, if left on for too long, it's going to cause inflation to spike. Inflation is just coming down now, so it might reverse this trend. Then the Federal Reserve will have to raise interest rates, which would destroy the plan to force them into cutting rates by lower bond yields, and then make everything more expensive for U.S. consumers and for refinancing the debt. So right now, the world's on an edge. It's too early to tell how Trump's tariff gamble will go. Will it pay off? Will it be an epic fail? You can't tell at this moment, but I mentioned at the beginning that no matter what happens, this is the end of the WTO system. It could also be the beginning of the end of the post-1971 dollar system, but there's no way to predict the implications of such a massive, massive transformation.
Well, that's it for Deciphering Trump administration. Thank you, Andrew, for your excellent analysis on Trump's logic.
Thank you.
IOG has been releasing multiple analysis and explanations on Trump administration. For Andrew's economic intelligence report and Suzuki Sensei's geoeconomic briefing, you can find them in the links below. Thank you all and see you at the next episode.
Thank you.
関税がもしアメリカがですねワークしていると世論が受け取ってしまうと我々としてはやはりその見栄養のもというかやはりグローバルな自由貿易良かったなということになりかねないというかですね